This is our Forex blog for March 4th, 2013, and as you can see here I have the four major individual currencies that most people will trade the currency pairs with: the dollar, the yen, the euro, and the pound. And basically these are a chart of a synthetic dollar index, yen index, pound index, euro index. You may not be familiar with such a thing because I created this myself and it doesn't exist out there in the market. Basically, I'm comparing every dollar to every dollar pair and creating a chart based on that. And of course, our statistical tools that we've had for the last 7 years that we're experts at, where we statistically compare every currency to every other one, is on there. And if you want to use our old-fashioned currency meter that basically just shows you the dollar, the real-time trend, the daily, weekly, monthly trend, you can watch that as well. I find looking at the index is a lot easier to predict future price direction and therefore do better trading. And basically the way I'm trading now is using the 8 indexes, the 4 you see here plus the pound, Australian, CAD, and Swiss, and simply buying the strongest ones versus the weak, selling the weakest versus the strong, and also doing what I call event-based trading, where for instance here in the pound, you can see it was underneath the previous day's high, the point of control, and it breaks out. And what that tells you is that the pound is making a higher high than the previous day, and that's a trend that's likely to continue. And when it doesn't, you're more likely to have a loss that's half of what you normally are looking for. Here you can see the euro broke out from above or below to above the previous day's high and then failed. So if you did take a buy in a euro versus maybe the dollar or the yen trade, and you saw on the index chart that the euro was failing to go higher and came back inside yesterday's range, and of course dropped underneath the point of control, which is one of the key price points, one of the best support resistance areas out there, because it shows you where most traders have positions in all the euro pairs. Above that you want to go long, beneath that you want to go short. And so when you have false breakouts, you might have a small loss. You can flip and go the other way and ride it down, ride it down. You can also use our hourly moving average. When a trend's down and the market over a period of an hour to 3 hours works its way back up to the hourly, it's a great place to look for a sell, like right here at 8:30. The euro is very likely to go down. And what's one of the stronger ones at 8:30? Well, amongst all of these, the yen is underneath its hourly moving average. At 8:30, the pound just went from underneath above the previous day's high. So pretty much it's a no-brainer. You want to sell the euro pound around 8:30. It's that simple. Let's just bring up a regular chart to show this in action. Here's 8:30. You had a little bit of a pullback. You can see a drop here, and then it pull back again. You go short, and another drop. And you can see it worked its way down to the fib target, which most of the time strong trends will work their way to the first or second fib target. So you got one trade here profitable, second trade here profitable, and most people don't trade the euro pound, but you pretty much make twice the amount as you do on the euro dollar. So this is equivalent to a 20 pip move and a 40 pip move. You can also see that the dollar was trending down pretty much since 6 o'clock. At 6 o'clock, the pound was going sideways, but about 2 hours later, kind of broke out. So 8 o'clock and onward, buying the pound versus the dollar makes sense. Now you can see on this chart, after 8, it's kind of slowly walking its way up, but you had a whole hour there to be on the lookout for a breakout, and it broke out, and maybe you would have got out of this trade with a small win, break even, 5 pip loss. You bought this next pullback, you made money. Basically you have a trend that lasted for hours, and because you can clearly see the pound is one of the few, or the only one on this of these 4 pairs that's above the previous day's high. It's very strong. It also found support in double bottom right here at the 15-minute moving average, which is in gray. Very strong. It's above the previous day's high. Double bottom right here, 10 and 10:30 and 11:30. You'll see from this chart here, you buy that pullback, you buy that pullback. Now, one of our new tools, it's absolutely amazing, is called the Perfect Oscillator because it has zero lag and is very predictive on future price moves. And what I did with this is created a moving average of the Perfect Oscillator and also plotted Bollinger Bands around it. At the plus 80 and minus 80 level, the market's extremely overbought and oversold. You can see the market stopped going up, pulled back. There's no oversold all day. And also it allows you to time pullbacks. When the market's trending up and the Perfect Oscillator is down near the lower Bollinger Band, what a great place to buy. Like right here, you're looking for buys right here. You can see it really never went that much down and it popped up. Right here, lower band. Guess what? Price. A lot of times I will draw trend lines over the bars high and not just buy it when it hits here, because sometimes it hits these bands and continues. So if you see it touch the band, just simply wait for a breakout over that bar's high, or like what I do is draw a trend line over the bar's high, and as soon as it breaks that trend line, I'm in. Right here, you can see it went from 92 up to 16, or almost, about a 27 pip move. Wonderful. Notice the lower band goes sideways, and it's also a good place to get out profits as you're seeing this go up. Notice it hits our upper Bollinger Band of my indicator right here, and that's the end of the move. So you're no longer wondering, how much farther can this go? This tool is statistical in nature. We go back over the last 20 days, and we're basically looking at the maximum volatility move over the last 20 days for different times of the day. And basically, if you are in a trade and you see this and you think it's going to go farther, what you're basically betting on, if you hold your trade, is that today the market's more volatile than it was in the last 20 days. So my advice is use a Perfect Oscillator on every trade, and when it hits the maximum level there, you can certainly hang on, but watch it like a hawk. For instance, if you might want to even drop down to a tick chart here at around 1500. Let's go down to maybe a 50 tick chart, and at 1500, watch it like a hawk. And if you're in this trade, just keep moving your stops underneath the previous tick bars low, and as soon as it breaks, you're out. So in that way, you're only giving back 5 or 6 pips or less, versus what a lot of traders do is they give back 10 to 30 pips on trades. I'd much rather get in a trade, whether it gives me 3 pips to 30 pips. When the move's over, I'm done. Wait for a pullback. If it meets my criteria, get back in it again, and not give back so many pips. Traders that get in and try to hold, there are some advantages of that if you want to hold a position when you're not watching it. But for the most part, if you have an hour or two to trade, why waste your time? This just maximizes your pip swings. So let's take a look at some of the other pairs. Let's see what the CAD did. You can see this one, broke out, came back, found support here at the hourly. As soon as it breaks out of there, that's a pretty decent place to be buying the CAD. We know that the dollar was weak today, right? So you basically are looking to sell the dollar CAD around 630. So let's take a look at that. Here's 630. Guess what? It's just kind of inching its way down. You have a nice little flag pattern right here. And what did it do? It went down. Got a pullback, went down. Pullback, went down. You're trading in the right direction of the trend. Australian dollar. Pretty much anytime you see a currency just chopping around going sideways for hours and hours, when it breaks out over that level, typically it's going to work. And when it doesn't, you can see here as a false breakout, failed. The second time, just took off. So the Australian was strong. The first time it failed, the second time it took off. But when you see the Australian fail and you're trading it against the weakest of all the pairs, then a lot of times you're going to get out of the trade at a break even, or you might even make money. Because just because the Australian dollar is going down against the majority of pairs doesn't mean it's going down against the dollar. So let's take a look at the Australian dollar. Strong Australian, weak dollar. Let's find the first time that the Australian broke out. It was right before 10. So here's a good example of it. If you took that trade and you had your stop right underneath the swing low, well, guess what? Even though the Australian dollar failed, like I just said, the Australian versus the weakest, one of the weakest of the pairs of dollar, broke out, came down, never hit your stop, took off, You always want to draw your fibs on the last swing, and guess what? Pretty much went right to that level. You get out with a small profit, and again, you can put the perfect oscillator on here to, really ridiculously time your trades.